Welcome. We're going to start with Wynn, which was just upgraded to a buy at Citi. Their Macau income is at an 18-month low amid the China lockdowns, but the firm is saying there is pent-up demand. Todd, what say ye?
Yeah, the Wynn stock has not fared well with the spike in COVID cases. Hong Kong got up, Kelly, to like 70,000 cases a day. It has come off. Data I saw was about 7,000. Inflation, let's talk about disposable income, is not as bad in China. It's only up 1%, so that's interesting. But, you know, gross revenue in Macau was down 56% year over year. They're probably going to be locked down for two major holidays coming up, and analysts are saying they really shouldn't open back up until May. So I think earnings immediately are going to be under pressure. They are expected to make a recovery in 23. Analysts are looking for about $3.30 a share. So it's 24 times earnings, not bad. If you look at the chart, it's kind of a big old mess, Kelly. We've been in a big old consolidation, not generating a lot of returns. If the chart can get up through about $87, maybe that target that Citi analysts just upgraded, about 96.5, could be reached. But I would proceed cautiously here.
All right, shares are at 80, so you'd like to see them really up to 87 before you take a sip, we shall say.
All right, let's go to JD.com. It's moving higher right now, along with other U.S.-listed Chinese firms or tech firms. Why? Well, first, Bernstein named JD.com a top pick, saying they expect the company's growth to remain resilient. It is also getting a lift following positive reports regarding U.S. audits of Chinese firms. What do you think here, Todd?
I like JD. It's actually the most interesting name on the list here. They're the second largest company behind Alibaba. They've built their own sort of nationwide fulfillment infrastructure. They're doing this last mile delivery network. They're a $100 billion company, reasonably valued. I think it's like 30 times earnings. The COVID numbers that we mentioned should be a tailwind for JD for online shopping. I think even though the Alibaba chart, which looks horrible. I mean, just an absolute destruction there. I think it's going to be hard for them to get market share. They have about 570 million users. Baba has close to 1 billion. So JD has showed relative strength. They're growing top-line revenue pretty consistently. They are sort of losing some rate of change with momentum. I mean, they did grow 23% revenue. Alibaba's only growing 10%. They run thin margins. They really try to focus on authentic products to the customer. They run only 3-4% margins. They're trying to cut costs, similar like Costco and Amazon. If the chart can get up through about, let's say 46.5 with support. If we can get up through 48.50 area, then I think you could maybe nibble on JD.
JD around 59 right now, Todd. So, you know, it's come back. Yeah.
Sorry. That's support, Kelly. I'm sorry, get my numbers back. That's support. We need to get up around 70, I think, is the breakout there. Sorry for that.
Okay, so I think it's fair to say on these you would be more optimistic if they start performing just a little bit better than what we've seen from the lows already. Well, let's see if that extends to Nio. That's the final name we wanted to ask you about, the EV company. Their deliveries hitting a quarterly record of nearly 25,800. They've got their SUV, the new SUV debuting next month. The other major Chinese EV firms also seeing some healthy increase in delivery numbers. So what about this stock?
Yeah. To your point earlier, Kelly, I mean, Chinese stocks have been underperforming the U.S. for such a long time. You really want to let the fundamental story sort of be taking you in when you do start to break some resistance. But, you know, Nio is, you know, it's a solid brand. It's a luxury car company. But from what I've read, Chinese customers actually have a little bit of a distrust for domestic automakers. They prefer Tesla. They are spending a lot outside of China. They're doing a lot of R&D, making moves in Europe. I think they're gaining some traction in like Germany, the Netherlands, Sweden, Denmark. So they're getting some room there. They do these 6 and 7 seaters. So it's had sort of an amazing run in 2020. Went from $1 to $60. It's pulled back. Wow. While the stock's above like 19.5, the downtrend is still in play. Again, let it take you into the trade. They reported earnings last week. Supply chain issues like everyone else. Their revenues are growing 50% year over year. They're delivering about 25,000 cars a quarter. So certainly a long ways away from ever being able to compete with Tesla. You know, I would just prefer to own Tesla in China.
Get a bottom line question here. Are Chinese stocks safe? I mean, is this where I should be putting some money in, or is it money that I can literally afford to say bye-bye to?
I'm gonna cite Jim Cramer, who I think his headline, if I'm quoting him correctly, is they're basically uninvestable. And I love that they're opening the books. The SEC's coming in and they're opening the books to audits. But from a trust point of view, I would say no. I have very little Chinese exposure in our portfolios. Yeah. And look at the chronic underperformance of the FXI.
So really,
compared to it's underperformed.
We just wasted 4 minutes, Todd.